Hey everybody, excited to talk to you today about a very interesting subject, one that goes up and down every single day, one that a lot of people can make millions and others can lose their shirts on. I don't know if anybody of you can guess it already, but take a few seconds, think about the clues I've given you, and let's decide what today's lesson is about. That, or you've already looked at the title, which is stocks. So, to kind of give you a good idea about what the stock market is, at some point in time, every single company out there needs to expand. Whether that means they're going to go through and buy more product so they can ship it out and make more money, or if they need to get new buildings, hire more employees, it all comes down to production. They want to do more, so they need more money to facilitate that. And so, in each case, you have two options. One, you can go to a bank and say, listen, here's my assets, here's my income, this is my debt. Will you lend me X amount of dollars? It could be in the millions, tens of millions, hundreds of millions. Then you have other instances where you can go out and you can become a public entity. You can raise stock. Now, by doing that, what it does is when someone owns a piece of stock, have you ever seen those funny shows where someone gets one share? And we'll say Apple, right? And they get this one share. And so then they go in and they want to order around all the employees of the company. Hey, I'm an owner, right? So do you own a piece of the company? Yes. Are you now the president or the CEO? No. So make sure that that you understand that when you're going into stock. Now, over time, stocks have actually been a very good investment. And you have to look long term when you're talking about stocks. As the economy's gone down, stocks go down. As the economy goes up, stocks go up. And there's actual terms for that. And these terms, as we talked about them, I'm just pulling up my notes here. You have a bull market and a bear market. Now, in a bull market, that's when the market appears to be in a long-term climb. Bull markets tend to develop when the economy is strong, the unemployment rate is low, and inflation is under control. Those three things are very important. So once again, I'll repeat them. Bull markets tend to develop when the economy is strong, unemployment rate is low, and inflation is under control. The emotional and physiological state of investors also affects the market. For example, if investors have faith that the upward trend in stock prices will continue, they're likely to buy more stocks, right? If you know something's doing well, you're going to buy more of it. If we have a heavy snow in the United States, you're going to go out and you're going to buy salt to put on your sidewalks, right? You're going to shovel and put salt down. Well, a smart person would find a sale on salt, buy a bunch of it because they know people are going to run out, and then you have a whole bunch and you can turn around and you can sell it for people, make a couple extra dollars here and there. If there are more buyers interested in buying at a given price than there are sellers willing to part, then the stock prices will continue. Very simple economics. If you have more of something that people want, and they're buying it, and so now you have less of it, but people still want all of that, you can raise prices to meet demand. Supply and demand. Now, bear market. You've heard that. That was a bull market we talked about. What's a bear market? A bear market describes a market that appears to be in a long-term decline. These are the scary ones. Bear markets tend to develop when the economy enters a recession. Unemployment is high and inflation is rising. So once again, a bear market is when the economy enters a recession, unemployment is high, and inflation is rising. Those 3 points. Investors lose faith in the market as a whole. It doesn't matter if Apple's doing good or Disney's doing good. They're scared of the whole stock market. Keep in mind that a sustained bear market is something that you should expect to occur from time to time, and that in the past, the stock market has risen more than it has declined. So is it scary to be in a bear market? Warren Buffett often says when others are running away, you should run towards. He's a very, very smart investor. Now he's lost lots of money, but he's also made a lot of money. This is where it comes into play. What should you do? Let's talk a little bit of history of the stock market. Let's go through my notes here real fast. Let's specifically talk about the stock market crash of the 1920s. reason I want to talk about that is even during the Great Depression, there were actually some positives that came out of it. So what happened? Right, you had the 1920s and you had World War II, and right in between there, the 1930s saw a huge disparity in lifestyles of the common man versus the super rich. Okay. Now, after the Great War, and for you history buffs, remember, it's not World War I. They didn't know there was going to be World War II, so it's called the Great War. You had the so-called Roaring Twenties, and it earned its name because the economy was booming. Things were going crazy. Money was flowing. People were buying stuff like crazy. Instead of going out and making themselves, they go to the store and buy it. Innovation and increased efficiency at home and at work allowed for more people to have leisure time. So instead of being on the farm all day from sun up till sundown just to make a living, all of a sudden people realized, I have time to go do things. So there's a few things they would do. There's cultural and social pursuits. So literature. A lot of famous books written during that time. Film. This is when the film industry really took off. And, you know, the other day we watched The Hobbit, the final installment of it. And films like that were made possible because of the Roaring Twenties. Music and very lavish parties. During the same time, women were actually gaining their independence and making their mark outside the home. Remember, up until that time, a woman's place was in the home, according to history and according to society. But now that's changed. That was changing at that time. Now, the good times came to a crashing halt on Black Friday. The date of this was October 29th, 1929, when the stock market crashed. Within 1 year, 5,000 banks had failed, and 6 million workers had lost their jobs. Now, by 1933, more than 15 million people. And so you understand what that means in there versus nowadays. That was 1/4 of the workforce. Could you imagine 1 out of every 4 people losing their jobs where you're from? That's how serious this was. So put that in perspective. 1 out of every 4 people by 1933 was without a job. Now, there's a lot of people who are going to try to tell you that the super rich were being unfair. And I could say the Great Depression, that was probably partly because of the inequality between the rich and the poor. As the economy went down, a lot of people lost their fortunes because of the stock market. People overnight lost everything. If you go in, there's a fun movie that we watch every Christmas. It's called It's a Wonderful Life. Have you seen that? Jimmy Stewart, and he goes in, and the famous scene where the people rush the bank. This is what happened. And they came in, and banks don't have all that cash on hand. And so these banks failed because the stock market went south, so they went to the banks to get their money. I mean, it was a very desperate time for everybody. And they went in, and in the movie, I love this scene. And Jimmy Stewart says, listen, Bob, I don't have your money here. We use that money to lend it to Joey and his farm, and John over here, and so on and so forth. And we'll talk more about how banks do their lending and how that works, but that's what caused the collapse. Everybody just wanted it. And the banks didn't have the money there to lend. And so for the vast majority of the 1930s, it was a time of misery for many Americans. But some interesting things happened during that same time. I've got some notes here. So you have the El Morocco, the Stork Club in New York. Those were roaring still. Extravagant parties. There were storefronts that stood empty, but the Waldorf Astoria, I don't know if you've ever had a chance, look it up or go there. But it opened in 1931. That was a cost of $42 million. And once again, you think, 42, that's not a lot. In today's money, that's $600 million. This was built during the Great Depression. They hosted a lot of parties there. It was amazing. The Ritz, another famous area, hotel, right? In fact, there was one party that Woolworth held there. It cost more than $1 million. And so during the time where, as we talked about, a bear market, recession became a depression, people who knew how to invest, people who knew how to work within the system that's provided, they were still making money. You can do that same thing in the stock market. There's many, many different avenues you can take. There's many different areas. That brings me to your homework assignment, which will be in the next video. Please make sure you take this homework assignment seriously. This is something that you'll be doing the entire semester. Every single day you'll be looking at those stocks. So please watch that video, do your homework, and I'll see you next class.